Welcome to the Private Equity Experience Podcast, your backstage pass to the strategies, stories, and secrets that drive value in the PE universe. No filters, no fluff, just straight talk and expert insights to help you navigate the private equity world with confidence. And now your hosts, Ed Barton, Rory Liebhardt, and Emily Sander.
We can surface some of those things, and it'll lead to jump off conversations about, either things we've seen and involved ourselves with, or, things that, people don't think about as much. That kind of
Okay. Let's
see how it goes.
Let's do that. All right. Okay. All right. Welcome back to the Private Equity Experience Podcast. And today we're going to be doing a grab bag. So we've actually been doing this podcast for a while now. Our book's been out as well. And we've gotten some
almost 2 years. Yeah.
Yeah. We've gotten some feedback and some thoughts and questions and comments, just all three of us from different people and places. So we thought we'd do a little grab bag of the reactions and responses and feedback we've gotten on the pod. And on the book.
Yeah. It's been fun. I mean, I've run into people, mostly people I know, but others that, I have just met and they want to learn more, that kind of thing. And people are curious about it. And that's generally what leads people, is like, what I'm finding is people have a very decent understanding about drivers to the macroeconomic landscape because it's in the news all the time. Right. But when people start, it becomes a black box to them, so to speak, when people start talking about how does it all get funded? How, what are the drivers to capital to drive the commerce and the economy? So that's where I think people are kind of diving into the kiddie pool here, is from that standpoint. It's like, boy, this is a place that I really don't understand that well. And I know you all, or at least I know Rory or I know Ed or whatever. And they're just like, well, they're doing it. So if they have something to say about it, I'll listen. And it kind of just blossoms from there a little bit.
Yeah, I've actually had a couple clients. I've gotten a couple clients because of the podcast.
No way.
Yep. One of which was a former coworker of mine who went off and did his own thing and has got a company that's growing really rapidly and is looking at private equity as a potential exit in the next couple of years, and said, hey, I know you've got this. Our board has watched some of your episodes. They think you might know what you're talking about. Mm-hmm. And so we picked up, essentially it's about $100,000 a year engagement because of the pod. Yeah. And a lot of it is exactly what you said, Rory. There's where we're trying to make it very tactical. Like this is not, there's mystery around it, but the mystery is very solvable if you kind of want to dig in. There is a real desire out there, and this is somebody who's a very sophisticated business person, where they're like, I just almost need a Sherpa to guide me through this.
That's a great,
so I don't fall into a crevasse. And that's and I'm like, okay, well, I can serve that purpose. Mm-hmm. And then of course we've got other professionals here at the firm that handle some of the more tactical elements of, the close and the reporting and KPIs and stuff like that. But it's been, the other part that I think has been, so that's some tangible stuff that's come out of the pod. But the other thing that I think has really been beneficial is being able to, and this is going to sound sappy, but that's fine. I'm in a sappy mood, is being able to like engage with you guys time and get a lot of, like, there's a lot of the war stories we've been able to get out. And I've had clients that are going through it like real time. Mm-hmm. And we've talked about that a little bit over the last year and a half. And I'm like, if they had just had this ahead of time, they would have been in a much, much, much better spot. So it's definitely been, regardless of whether we had just the three of us listening to the podcast or whether you have, several hundred people listening to each episode, it's really been beneficial from that perspective.
Yeah. It seems to me like everybody's got some scenario. When I talk to them, they've got some scenario that kind of involves private equity or seems to be on, as you said, like with your client, Ed, like on the horizon where that becomes a thing. So people are thinking, okay, I need to learn a little bit about this to either sound intelligent or for their own curiosity and situation. But it's definitely a matter of how, how prominent private equity is in the economic landscape, that people, no matter what part of business they're in, whether they're in operations, finance, whether in marketing, sales, that everyone's got some connection somehow, some way to private equity, and so they're like, wow, I didn't really know where to start. This is a good place to start. And so I've had then follow on conversations with people and, kind of done some consulting around helping people with specific scenarios. But yeah, it's a great jump off point. And I get the same comment about the book too, really. And I get it's a matter of talking to very sophisticated, very intelligent people that just are not subject matter experts yet in this space. And, they see it as a great entry point to that. And of course, with smart people, then they want to learn more and they want to dive deeper, but it is a good jump off point no matter kind of, what level somebody's at within the financial game, so to speak.
And I know someone who actually, in their previous career, had billions of assets under management they were in charge of, and listens to our pod because he's like, I like how you guys talk about it because it reminds me of some of the fundamentals or some of the things that people would have confusion around, and so it really helps me look at it in a new way. But he's well versed in all of this, but he's just like how you guys break it down, how you guys.
Well, I'm sure he appreciates getting an update on the definition of risk premium.
Oh,
pretty much every episode.
Yeah. I mean, it does have nuances that change with every context in the news. But that's the other thing too, is I find that, the people tune in. Some people tune in more when they see that it's a salient topic regarding what the political economy of the U.S. and how that's affected economically in private equity, or they see a situation they may have read about, but we're explaining it from a private equity angle. Then you have other people that are like, oh, and it's really kind of fundamentals or principles of private equity. That's when I'm hooked in. So it's if you got a news junkie that wants to learn more about finance, that's when they tend to tune in. If you have somebody that's looking for fundamentals, then they might listen to it all, but they specifically tune into when we're explaining, as you say, like the definition of risk premium, or what a capital stack is, or risk adjusted rate of return, whatever that may be. People want to add to the tool belt. It's cool. I enjoy it because I didn't know that I liked talking about this stuff as much as I enjoy it. I think part of it is our conversational element to it, because we usually harken back to some war stories and get a chuckle out of those, because really they are all pretty funny when you think about it. But yeah,
they're far funnier now with some distance and perspective.
They were not funny
than they were in the moment.
They were prematurely aging me while I was going through that. With a few years, decades of removed, like maybe it's a little more funny to look back on. But yeah, it's been good.
Yeah, we should our next book should be like the pros and cons, or the do's and don'ts of husband and wife founders. Because that's a whole,
we can create a series, actually.
That's a whole
category. Do's and don'ts about dragging a founder along into the next stage.
Oh,
who knows? We could write. Oh my gosh, so many articles, so many situations, that sort of stuff. I mean, maybe the next frontier for us is a Substack or something like that, where it's actually like a newsletter of this sort of shit. But we all have the day jobs too, so.
Well, I appreciate the fact that, given our backgrounds, we come at things from different angles. So obviously you guys are like the financial wonks and the quants and all these crazy acronyms. And I'm like, what's happening? And so I proxy for the normal people listening to the show. But I've been part of PE-backed companies on the leadership team, and from a process and people perspective. So, hey, we're running cycles and due diligence and data rooms for prospective buyers, like running that process behind the scenes, but then also the change management aspects for the people. Like we're talking about people and who are getting throttled and whose lives are changing significantly. And so there's that whole layer of things to consider as well.
Absolutely.
So that's where I usually come at things from, but just speaking with you guys in depth, I just learned so much. I mean, I learned so much from working with you, and I would kind of try to keep up and like pick up every 12th word you were saying and put it in context. But hearing these episodes, it's like, no, I can get it down. And I ask questions repeatedly because it takes me that long to get it in my brain, but it's putting together this whole picture of the private equity landscape and the private equity experience.
Yeah.
And I think that a lot of people can, like you were saying, Rory, pick up on like, I like the news aspect, or I like this aspect, or I can relate to the people aspect because I just went through that myself, type of thing.
Yep. Yeah, no doubt. And I think that's, I definitely had folks say, the three of you specifically have your own style and approach to the discussions, which is, well, I guess that's why we formed this particular group that we did. But I think we've all been in it together. We've all been in our own right, but being able to, I don't think that the content would have been created if not for this particular combination of people, so I guess we found the formula, and I guess it's a question of just, where we go next with it, I suppose.
What are you guys hearing that's top of mind for people? Are things top of mind, fresh, news cycle, worrying, or what's the sense you get there?
What I hear, it's so funny. It's when people listen to what we have to say about private equity specifically, they naturally believe we have the answers to whether the economy is going to go into a recession or what are interest rates going to do. My crystal ball is pretty foggy at times, so it is funny how people think that the information we have to share is something that we also have the ability to predict, which I think we have a somewhat informed view, but like everyone basically wants to know, is the economy going to sputter, or is it just going to somehow miraculously continue to, stay on its trajectory or grow, and so I tend to be even more bearish
because it's a cycle.
Yeah.
So it always sputters. It's just the when.
Yeah. Yeah.
So my ability to predict, I can predict with 100% certainty that it will sputter.
Yeah.
What I can't predict is the when it
exactly. We're pretty deep in this cycle, it feels like to me.
Yeah, and I've predicted like 6 of the last 3 recessions. So, I'm probably not the guy. I tend to be kind of a glass half empty, a little bit conservative on the approach. Yeah. And I continue to look at things like, okay, we've got, as we're recording this, we're kind of we have a precarious hold on a ceasefire in the Middle East around oil access, which again is when you have an energy shock, that tends to have impacts on a macro economy. And I'm looking at it going, I don't know if that's going to hold or not, and what's the opportunities or lack of opportunities being driven by the fact that the Middle East looks like it's about to be, it's always been a little bit rocky, but I think it's going to be rockier over the next probably 24 to 36 months, because I've also predicted 9 of the last 3 wars. Is the Iranians are going to not play, but they're going to delay. And then it's going to be okay, well, we're going to have to go in and boots on the ground and do all that kind of stuff. And, that ends up turning into a macroeconomic issue, a big one. And a stabilizing force, a big one.
Yeah. Yeah, it truly is. And, that's the other area where people are curious about is like, how does what's going on in the Middle East and that sort of thing predict or like impact private equity and, just general investments and things like that. But I think the resiliency of the consumer is what really has me scratching my head all the freaking time. Cause I get so angry about the level of inflation that I'm realizing in my life. And, we all have different parameters for what it feels like to be squeezed. Right. So I can only imagine in other areas where somebody's like, oh, my grocery bill's gone up by 50% the last year and a half. Yeah. Whatever. It's just like, how far can this consumer go before the consumer breaks, But we haven't seen things like bankruptcy filings. We haven't seen delinquencies spike on debts. We've seen certain subsectors of debt underperform, subprime auto being one of them. But, all that to say is like all of this stuff does eventually come to roost, but I'm just so surprised by how how long it's taken, because, we are so deep in the cycle. I think everybody predicted that COVID itself was going to be the breaking point, but then of course, other stimulus and things like that, and then just jobs and other things have continued to remain resilient, that sort of stuff. So I don't know. It's shaken my confidence in my ability to predict the future for sure.
And it looked like you were going to say something, but I've gotten the feedback that what's top of mind for the people I'm talking to is AI. It's like AI everything, blah, blah, blah,
Yeah.
blah. And I think one of the pieces, we've touched on AI, but one of the pieces we talk about is the fundamentals of how to run a good business, which is the precursor and prerequisite to any PE transaction. Because if you have a poorly run business or not something that's not profitable, doesn't really matter. You're never going to have the PE discussion as such. So,
well, certainly not from like the growth equity groups.
No,
but more like the vulture capital you would be having painful conversations with. But yes, but point taken. Yes, you got to how to run a good business and be cognizant of that is fundamental for sure.
Yeah, I was actually going to take the position you kind of touched on it, Rory, that there's almost no business of size that is off the radar for private equity. It's just which fund and which
price. Yeah.
So you've got ones that specialize in, and we've talked about this, they specialize in debt financing. Some specialize in turnaround or kind of the clean up the mess or dispose of the mess, kind of troubled asset recovery. Some are, growth equity. Some are really venture firms, but late stage venture firms that call themselves private equity, but they're really they have more of a venture profile.
Which really quickly, I got to jump in on that one. My recent phenomenon that I personally observed is that venture capital funds that call themselves that now much more resemble private equity funds out there. They're requiring businesses to have way more traction, obviously product market fit, but like actual ARR on their books to then invest, which is, remember back in the day, like not too long ago, it was like, if I just have an idea, I'd have people at my door. But no, these days it seems like the run-of-the-mill VC is looking for more advancement, which don't mean to pull you off your thought process there, but that was one thing that stuck out to me over the last year is the changing dynamic of VCs looking more like private equity firms and how they interact and execute.
Does that change the whole like chain reaction? Like, so angel investor role changes, VC role changes, PE role changes. Maybe he doesn't change. Yeah. More competition? Or?
Well, there's a few factors at play. I mean, as a founder, you have to continue to decide how long you can bootstrap a business before you bring in institutional money. Angel investors might also have to be in the same boat to say, you're going to have to hang on longer. And by the way, still probably be diluted. Are you willing to do that and continue to pour money into a business until the VCs come along? So it could be a longer tail for funding, either as a self-funding mechanism, bootstrapping, or with early stage investors. So like seed rounds go on for a longer time, I guess is the way to put it. So yeah, there's a little bit more of a chain reaction that way, I'd say. Yeah.
Which is like not necessarily a bad thing per se. It's just kind of a change. What would you attribute that change to?
I think what I personally observed is just like there's a lot of capital out there, but there's just general anxiety, maybe a too harsh a word, but nervousness about where the economy is going to go, like especially for, consumer facing businesses or other certain types of B2B business models is like, is the thesis of the founder and this business plan relevant 6 months from now, 12 months from now? So reticence to get in now because they don't feel like it's on the up and to the left type, up and to the right trajectory. It more might be like straight line or down and to the right. So, who knows?
Well, the longer we continue to go into this cycle, historically we are in a fairly long growth cycle.
Yeah.
We've had,
Definitely.
really, I don't know if we've even had a technical recession really since COVID. And so
we have not.
we're getting,
Correct.
yeah, I was about to say, because that's a technical recession is 2 quarters of negative growth.
Yeah.
2 consecutive quarters of negative growth. And so, we're in an extraordinarily long kind of, I don't want to say it's been a rapid growth environment. Really coming out of COVID was rapid, and it's kind of steadily, it's the central bank and others have done their job. The issue though is, as I mentioned earlier, it's always a cycle and it will sputter.
Yeah.
And I think the longer it goes, everybody goes, okay, it's got to be closer to the sputter. And so there, as Rory noted, the up and to the right is not only when you're looking at the companies and kind of where they sit in the macro economy, and but also I think there is a general feeling that there's got to be a correction here somewhere, whether that's in the stock market, whether that's in the macro economy, or both, that will impact valuations. Valuations are at record highs from a kind of traditional metrics. Or we're going to see it. Yeah, or we're going to see a macroeconomic decline, which is going to impact, even if you stayed at the current metrics, is going to impact, which are silly, but I've been saying that for 40 years too, and
totally
it's still working. So but I think that's folks are just getting nervous.
Yeah,
I think and the longer this goes, the more nervous folks are getting, because they're like, again, I'm one that goes, okay, what's the contrarian investment that you should be making today, assuming that the economy sputters, or that there's a pullback to more traditional metrics of valuation, which, if you look at my stock portfolio, I think we've talked about that on here. It's largely consists of utilities, energy, consumer goods. It's a classic like defensive posture, dividends, the whole 9 yards, and going up to, well, what, because if interest rates fall, then dividend paying stocks tend to go up in value. So I'm like, I'm trying to play on all those things.
Yeah.
I'm still working, so I obviously have not found the secret formula.
Yeah. Amen. Exactly.
As someone who barely passed their macroeconomics college course, I do learn a lot about how, like, events in the world actually do impact these things that I know. I honestly think that I would get more out of that class now that I have life experience and business experience, because
I say that about a lot of things in life.
I don't understand.
Yeah.
But if you were to take on what you just said, Ed, and we're like, okay, it's going to sputter at some point. I think we're getting closer and closer and closer to that tipping point where that happens. And I'm somewhere in the PE ecosystem. I'm considering PE. I'm in a PE investment. I'm a PE managing director. What does that mean? Like, what do I plan for if I'm getting a little...
I mean, the biggest thing is, it's tougher to plan for the exit, because the exit tends to be driven by, I've got to get a multiple of X on my initial investment. And so, as some of these things occur, the question is going to be, okay, where do I buy for value? What do I look at for leverage?
Yeah.
Because you got a double-edged sword on leverage. You could actually, if you got a good cash flow and conservative business, you could throw a bunch of leverage on it to get to that return. Especially if it's a counter-cyclical or a, kind of reasonably resilient economic play.
Yeah.
Versus a company where you're going, well, I don't know, but I've got a bunch of capital and I'm a growth equity fund. I got to put it to work somewhere, otherwise I don't get paid. So you just go in and you start throwing leverage on it to try and get returns on top of a real high multiple environment and a potentially challenging macroeconomic environment. If the winds blow against you, you're not going to be able to tack out of the storm type of thing, and it's going to be ugly.
Yeah.
But some funds and some firms are so wedded to a particular style that that it's impossible and would be a disservice kind of to their LPs. The LPs should be diversified at the LP level.
Yeah.
The funds don't necessarily, and should not arguably, be diversified at the fund level.
Agreed.
And they should be able to say, this is what we do, and take their lumps when the lumps show up.
Yeah. The other answer to that question is, if you're a fund, you hope that you are, fully subscribed in a recently closed fund, meaning you've just raised the money, because then you're on the hunt for great deals, right? As you said, in some areas where there's decimation, there's value in the rubble, right? So, you can go buy if you're in a new fund and you just raised a bunch of capital, you're out to deploy it. That's your job, and you have, let's call it 5 to 7 years time horizon to realize the value of that. Then maybe you're in good shape, and you can go out and do things others that in that cohort can't do because they're, in a different situation. Maybe they're fighting against liquidity or redemption demands or whatever it may be. So having fresh dry powder when stuff goes bad, could be a good place to be depending on your investment strategy.
Are there PE funds that go, okay, we're in a downturn. Mm-hmm. I'm going to see which companies are resilient. Not that they're like making, profit over profit, but they're doing less bad than everyone else. So they're most resilient. And then I'm going to use that as part of my appraisal process.
Absolutely. I think that is one very tangible way in which you can prove out the durability of a business, and how much the demand for what it does persists despite downturn. And if it means that you've got less competitors that are PE funds that have other liquidity issues, or they don't have fresh dry powder, then you might be in a position to buy a business for a great price where you don't have other competition or very little. Yeah, it's a good place to be, 100%. But Ed and I, the business that we worked in, while we were not buying businesses, we were effectively buying distressed portfolios. And so when we had capital, when stuff was bad, we got some of the best deals that company ever saw.
Oh, it was silly.
And
as a matter of fact, we kept going.
Value sold the company after that. Perfect. It was great. And so,
we wanted more capital.
Yeah.
I remember I'd be pounding on the table with Dallas going, we could, and they're off buying. No, they did fine on the other stuff too, but they're off buying banks and mortgages and all. I mean, but our biggest competitor went away.
Yeah.
And all of a sudden everything was just sitting there.
Yeah.
As Bear Stearns was our biggest competitor, everything was sitting there.
Mm-hmm.
And it was like we could back up the truck because the banks are getting slaughtered.
So for people who just are listening at this episode, explain your business model.
So our business model was banks have a requirement to have certain capital levels. And what happens is we'll use consumer bankruptcies because that was our world.
Yeah.
What happens is a consumer files for bankruptcy. So the economy goes bad, consumer files for bankruptcy. The Office of Comptroller of the Currency, who kind of looks at the banks, goes, you have to make that credit card account, because we bought largely unsecured. Oh, there's some other stuff in there.
Yeah.
You have to write that off to zero. So you have to write it off because your debtor went bankrupt. The issue is, like on a Chapter 13 bankruptcy, you're likely to get paid out 25, 30 cents on the dollar. In a Chapter 7, you're likely to get paid out of 1%.
Mm-hmm.
But the regulations say the bank has to charge it to zero. Well, the bank at the same time that folks are filing bankruptcy is getting slaughtered with, other bad loans and other things, and are trying to hold their capital up. So so what do they? They go, well, I'm going to sell these things because we'll give you 10 cents on a dollar, 12 cents on a dollar, and we'll wait the 5 to 7 years to collect the remaining, to double our money,
mm-hmm.
which is a 15, 18% return before leverage. And the bank goes, okay, we're mitigating our losses. We had to take this $10,000 credit card, charge it to zero. At least now I can get $1,000. So I only have to write off $9,000.
Yep.
And then that $1,000 goes against my capital reserves, which are being evaluated by OCC.
Mm-hmm.
So, it's really one where we weren't regulated in like a bank. And so you had the ability to go, we could wait for the money. You can't. We'll take the risk, because in a large pool, any one given account is likely to not pay.
Yeah.
But a pool of these accounts is very predictable
mm-hmm.
as to how they liquidate. And so that was our business. And we did that for, Rory still does.
I still do.
I mean, it's, it's 25 years of it. Rory's been doing
wow. My goodness.
And so when you were saying we were asking for more capital, is that to buy more of the?
Yeah, because the banks, I mean, you think about this. This is 2008,
Ooh.
2009, 2010. So everything's gone to hell.
Yeah.
And the banks are getting slaughtered. And our largest competitor in that space, we were the number 2 people in the space, or number 3. our largest competitor was Bear Stearns.
Yeah.
And Bear Stearns went away. They got bought by Chase, and Chase is like, yeah, we're not going to do this anymore.
Yeah.
So what ended up happening was, we're sitting there going, you got all these big banks need to get rid of their bad loans, and the biggest money that was in that market went away. So we were like the only big player left, and we're us and another company, Sherman Financial Group, and we're like, just what I was telling Dallas, we were owned by Lone Star Funds at the time. Give us all the capital you can, because I can deploy it profitably here and give us, 18%
tremendous supply
for leverage
because of the bad economy.
Did they
little
give you
demand
capital?
because of the capital crunch?
Not enough.
Not enough.
They didn't give us enough. What they did do is they bought most of Merrill Lynch's bad assets.
They did,
which turned into a home run.
Yeah.
They bought CIT, which was a home lending business. CIT's home lending business, which was at least a triple.
Yeah.
They had bought a couple other mortgage companies, the one of which that they had me go deal with. Not a good investment. They poured more capital into that before they put it into Chapter 11. They should have sent that capital to Beeline.
True.
And there was a couple other investments that they made, hoping that the turnaround would be quick, and it wasn't. And that was part of the issue. And they were heavy at the time in real estate.
Yeah.
So
resi.
We had, restaurants and grocery stores and other things where they bought it largely for the value of the underlying real estate. And that becomes a little bit of an albatross when the capital markets are frozen up.
Yeah. Yeah.
What else are you hearing from the listeners, from the viewers of the pod or readers of the book?
I get a lot of questions I don't have a quick answer to, i.e., what are y'all going to do next? Are you guys going to write another follow-up book? Are you guys going to, continue to do podcasts? Are you looking to do, live events, whatever? People ask these questions with, genuine quick curiosity. And I think, I don't think we've settled on that yet. So listeners, what do you want to hear? What do you want more from us? Because we are ourselves looking to determine how we take this.
That's the first I've heard of a live event request. I've heard are you going to do more books or like different kind of podcast episodes or whatnot?
Yeah.
That was the first I've heard of a.
I'll do a live
event.
You'll be
great
just
live
get talks, like town hall style,
panel Q&A. Something.
Yeah, we could do that. That'd be fun.
Yeah,
I'd enjoy that.
You've done some of that, haven't you, Ed? And you've done some of that, haven't you, Rory, or not so much?
I've done some,
for
sure,
but I haven't done a lot of late.
Yeah.
Most of that was done several years ago. Back when podcasts, I was like, I don't know what these things are, but I'll go on them because it's fine. I've actually been too busy to do that stuff of late outside of this one.
I've done that stuff representing, companies I've worked for, but never have I done it for like my own thing or our own thing, So this would be something very different, but, getting in front of people and, spreading the gospel, that's not new, but, doing it on something we've created, that would be both new and fulfilling. So,
yeah, I mean, I would like just to workshop that just hypothetically. I mean, one of the main goals of writing the book was to educate people and just kind of pull the curtain back on this ominous, kind of confusing black box of PE. And I think I said in an earlier podcast, the biggest reaction I get to the book in the pod, like, oh yeah, like, with my former CEO and CFO doing a book on private equity, is this sound, ooh, private equity. Like just dispelling that, like, okay, it's not as scary as that. And like, oh, but like those people in private equity, it's like some of them, yes, but it's also can be a win-win if you know what you're getting into. So I think if it's expanding that education, like, hey, like here's what it's used for, like here's what it's good for, and if you're in this camp, like if you're in this scenario, don't use it, not the tool for you type of thing. I think if it's anything to do with that, I would be game, because that was our original premise.
Yeah, it could go a lot of directions for sure on that front. Like an event could be geared towards, founders and entrepreneurs that have something they're considering, but they're looking towards the long term and what that might mean for their business. 10 years down the road, who knows?
But this could go a whole bunch of different directions, because
it really could, yeah.
We could speak to PE funds themselves, managing directors. We could speak to leadership teams and founders and executive teams. We could speak to have a whole workshop on if you are a husband and wife team, come to this talk because you need to hear about how to do this.
You need to hear about being a husband-wife team in private equity land.
Mm-hmm. Yeah, because there's good parts of working together, but there's also you need to know these things before you get into bed with PE. So I feel like we
so many offshoots, right? You could even make it topical, like a series that's topical to some of the fundamentals of the book, right? So some people want to know, how do I become an effective chairperson of a board, right? As a CEO, founder person, or how do I manage a board? I remember when we worked at a company, Ed handed out books. Ed was the CEO, handed out books to the executive team on basically working with the board. Maybe it was the other way around. You handed a set of books out to each of the board members to basically be
I gave it to everybody.
I
gave it to everybody,
but I think you also gave it to the board members too.
So I did.
We all had it. And that was really pretty cool because it a lot of us, myself included, had never worked at that level before. And a lot of the board members had never been board members before. We're real ones,
Yeah.
So
that would be a good future.
Let us know, listeners, what you want to see and hear, because we got you covered. We'll figure that out.
And with that, we'll call this one a wrap. Thanks, Ed. Thanks, Rory.
Thanks, Em.
Thanks, Em.
If you enjoyed today's episode, please like, share, and subscribe wherever you get your podcasts.